Welcome to day 2 of the ABARES Outlook conference. Fascinating day yesterday, which was setting up quite a precedence, I thought, of some very topical things for some of the discussions that we're going to have through the course of today. And I think one of the things that stood out for me was, firstly, I'm John Howard. I'm the CEO of Regional Investment Corporation, so the RIC. We're a government provider of concessional loans, primarily it is into the ag sector, mainly helping with recovery through droughts, which is our predominant role. And the concessionality of those is really about trying to help people recover. So provision of capital, which is actually the whole context of the discussion that we're here today. So sowing seeds of investment, attracting capital to ag. And where I was going with setting up some of the discussions yesterday was actually around risk and the pricing of risk into a sector where we're seeing plenty of opportunities still there with for ag in Australia, but also in that global context, the increased risk that's actually coming into how we operate and how the world operates brings a completely different context into how risk is actually priced. And therefore, on the back of that is how do you actually attract capital into it. So some of the things that we're going to be exploring today is looking at some of the demand side of things. And we've got a panel here that's going to really help work through some of where those opportunities are, but also look at different ways of that capital is actually coming into this sector. So what I would like to do is just give you a bit of a context of how it's going to actually work together. We're going to set the scenes in the first instance, and Dale Ashton, who is a program lead and farm analysis with ABARES. So Dale will take us through some of the context of what we're seeing in the space at the moment and some of the gaps. Then we're also going to have Dr. Nicola Thomas, thank you, who's with the Faculty of Business with Charles Sturt Uni. Then we've got Charley Cramer, we're going to start looking at some of the different avenues and access to capital at the moment. So Charley is National Head of Agribusiness with AgFin Australia. So we're going to look at some of the non-bank private credit avenues that are now opening up more and more into ag. Then there's a really interesting piece of how our RDCs are broadening out into the venture capital space and trying to find avenues of new to enable investment in innovation opportunities. So we've got Jesse Reader, who's here from Hort Innovation. And then on the corporate private equity side of things, and one of the original proponents in this space is David Bryant, so Managing Director of Rural Funds Management, who'll be able to take us into how that private equity space and how the opportunities in ag is continuing to be funded and sourced. So without further ado, what I might do is hand over to Dale, and he'll be able to take us through some trends in farm debt and investment in farming, and let's lay some of the groundwork that we'll be able to explore a little bit further as we go into it. Just before I hand over to Dale, just if everyone could just check their mobile phones, make sure that they're actually on silent. There's also, please encourage people to tweet, so hashtag ABARES Outlook.
Thank you, John, and welcome all to the session. So this morning I wanted to raise some ideas, kind of to set the framework for our discussion for the rest of the session. And our focus today is to think about investment helping agriculture to grow. And as a starting point, we need to think about, what's the demand for investment? Where's that coming from? So we already heard yesterday about some of the challenges facing agriculture, the importance of productivity growth, but also those challenges of emissions, global events, the trade session yesterday afternoon. And agriculture can't meet these challenges without new investment. It's always, a long-held thing in agriculture that it's the investment that helps agriculture to grow. But what do we actually mean by investment? And what kind of investment is important for productivity growth? Where are the funds for this investment? So we're going to explore all of these things this morning. And I want to start by looking at some trends in investment on farm, because when we look at that both in aggregate and by industry, we can see which parts of agriculture are growing or lagging behind. And this helps us start to think about where those gaps are. Investment off farm is also really important, so things processing, transport and so on. But I'm just going to focus on farm this morning. So it's a good idea to think about what we mean by investment before we go too far, and as an economist I like to grab my first year economics textbook, and we would define investment as expenditure on capital, plant, machinery and so on that provide ongoing productive benefits or a flow of services. And I like the flow of services bit because that's a really important input into our measure of productivity. So it's really important to recognise the role that investment plays. For agriculture, this also includes land, and for most farms, land accounts for the largest proportion of the capital that they have invested. So aggregate investment in agriculture has grown in recent years, but it's generally been steady over the long term. So what I've shown here is just a 10-year average of just over $10 billion a year for broadacre and dairy farms. So we don't have detailed data for the other industries, but I think broadacre and dairy farms probably accounts for about 2/3. In recent years, there's been a large increase in new investment, and as you can see by the jump in the graph there, much of that's been for land purchases. But if we exclude land, the aggregate investment's more like around $4.9 billion a year, jumping up to $8 billion in 23. And it's important to think about, why have I excluded land? And while land's an important investment for individual farms, most of the new investment in land land purchases is mainly transfers of ownership between farm businesses. So it's only when there's a significant change in that land use that we would expect to see any real influence on productivity. So most of the growth in non-land investment has been by large farms. And when we look at farm investment by size over the last 10 years, the largest 25% of farms by turnover on average accounted for around 60% of aggregate capital investment. And by industry, this group of large farms is mainly dominated by large broadacre cropping farms and to a lesser extent large beef farms. So cropping has benefited greatly from mechanisation, technology adoption and increased scale. And these large cropping farms have really dominated a lot of our statistical measure in probably over the last decade in terms of productivity growth, farm income and investment. Investment by smaller farms has been much more modest, with the smallest 50% of farms, so we're talking a big chunk of the industry, accounting for around 22% of aggregate new capital investment. And most of these are small beef and sheep farms and the smaller mixed livestock cropping farms. And many of them are located in high rainfall zones, so they're sitting on large property values or around the fringes of the wheat-sheep zone. Now, the main source of funds for all this investment, including land, comes from debt. And I just wanted to reflect kind of quickly, particularly because of the historical focus of this particular conference with ABARES' 80th year, that if you go back to the 50s and 60s, most farm debt sat with pastoral houses and was mainly working capital. And it wasn't until the 80s and the 90s that really the banks took over, and that investment that happened in those decades led to the productivity growth that we started to see in the 90s and the 2000s. And there's a great session this afternoon that will explore that in a lot more detail. So the main source of all the funds for investment that we're talking about comes from debt, and farm incomes now mainly play a role of servicing debt rather than providing a source of funds. So in aggregate, farm business debt's increased by around about $30 billion across all industries in the last 5 years. And these data also suggest that there's been growth in industries, horticulture in particular. So we heard in the commodity discussion yesterday from Fred about the growth in the horticulture industries, but also cotton, pigs and poultry, whereas there's been a decline in aggregate lending to dairy and sugar, mainly as those industries have contracted a bit. So much of that increase in aggregate debt, as with investment, has been due to borrowing for land purchases, and to a lesser extent to finance ongoing working capital as those farms have gotten bigger. So if we look at it for another way, if we take out land purchases and working capital, around 1/4 of debt on broadacre and dairy farms covers the investment as I'm trying to define it here, and that's shown by the creamy yellow line at the top of the graph there. So we can see it's been increasing, not at the same rate as debt for land purchases, and not that that's necessarily a bad thing. But what this suggests is that many farmers have been focused on getting bigger to achieve economies of scale rather than investing in new capital or technologies. It's also important to note that debt is not evenly distributed across farms. So in broadacre and dairy, 5% of farms, the largest 5% of farms, account for about 40% of that aggregate debt, whereas nearly half of those farms have little or no debt. And what debt they might have is mainly related to working capital. So if we relate this back to investment, we can see that a large proportion of farms remain debt-free, which is great for their balance sheets, and they're mainly relying on farm income if they're funding any new investments. And most of these are the small beef and sheep and wheat and other crops farm that I've already mentioned. So many of them are not making sufficient new investment to maintain their productivity growth. And this is where we start to begin to see some of the two-speed agricultural economy that Jared referred to in his talk yesterday. So this is part of the challenge we face when thinking about increasing farm investment as a whole. So I wanted to finish up, I guess, with some possibly random thoughts, but 80 years ago when ABARES formed, there was very little debt on farms, and investment was all driven by farm income. So there was a lot of concern at the time. If you go back and read some of those old agricultural economics journals that are sitting on the table outside, there's a lot of concern about how do we get investment started. Well, that took another 30 or 40 years before it really kicked off. And as I mentioned before, debt financing of investment really started to grow in the 80s. Now there's a whole bunch of rising alternatives to debt financing, so other sources of funds for investment, which is what a lot of our panel will be talking about this morning. And investment is also more than buying big, heavy things. Sometimes it's about technology, so they might be small but really clever things. So at that point, I'm going to hand back to John and look forward to the panel discussion.
Righto, so having set the scene, we're now going to pass over to Dr. Nicola Thomas. Nicola is with the Faculty of Business with Charles Sturt Uni and is a lecturer in economics specialising in the evaluation of soil, carbon, climate change and agricultural land use. So on that basis, Nicola's going to help also set the scene around some of the opportunity, and would you like to go from there, or would you like to stand up here?
I'm happy to go from here. So thank you very much. I've only got the one slide, so I can probably hand it straight over to you. So I thought just to set the scene, I've been working as part of a team on a project, and I now see that the graphics would have been a lot better without the lights because you can't read any of the text, but that's okay. It looked good on the computer. So we're part of a team with a federally funded One Basin Cooperative Research Centre, which is sort of about bringing industry, researchers and the community together to undertake research projects. And this is all around the Murray-Darling Basin. And sort of what we've been doing is sort of going out, and the team that I'm part of, we're going out and talking with farmers and sort of saying, well, look, what sort of things are you doing to improve your sustainability? What would you like to do? And how can we, what sort of incentives, financial incentives or otherwise, do you really need to sort of, implement those? And, are there any barriers for you to implementing them? So the end result, again, like Dale, John, everyone's been talking about, is to try and improve their productivity. So it's mainly in high-value irrigated agriculture. So we're talking about grapes, wine and table grapes, citrus, almonds, mainly those sort of crops. And sort of going, okay, well, how can you use water more efficiently and also increase your productivity? And so we've sort of been chatting with farmers and finding out some of the barriers, and without wanting to sort of go into it too deep, mainly it's around age and then their capacity to be interested in taking on more risky debt, to finance these new sustainable activities, and also the sort of relationships that they may have. But it's mainly around that age and that sort of risk tolerance, because the younger people are typically more highly leveraged than the older farmers that are sort of looking to sort of wind down and get out of the industry. So that's sort of what we've been doing, and then it's really about moving forward. It's about what can we do to bring the finance community and farmers together to develop a framework to increase the adoption of these green finance mechanisms to improve sustainability and productivity.
What we're seeing there is part of the evolution of the demand for capital as well, as market priorities or realisation of change, whether it be environmental or market-based, of where those gaps are or demand is actually coming into play. So what we've seen out of Dale and Nicola is probably some of the demand side of things of capital and how that's evolving and changing over time. And to Nicola's point there, the intergenerational change that's also going on, and therefore the propensity or willingness to people to actually take on debt to actually drive change. So what we're going to now move into is looking at a couple of different avenues from the supply side of things where capital's actually coming from. And the first one we're going to touch on is have Charley Cramer. So as I said earlier, Charley's the National Head of Agribusiness with AgFin Australia. He's a business professional that's been involved in business, corporate, wholesale, commercial banking, and now non-bank funding. And he's going to be able to give us an idea and his topics around the growing role of non-bank sector in helping producers realise their goals. So Charley, be really interested to hear how this new avenue of capital provision is coming into this sector.
All right, thank you, John. There was a couple of excellent charts that I had prepared. Thank you, Australian Financial Review. And what they were, it was effectively, one was a bunch of steps explaining the difference in non-bank lending or non-traditional lending over the last decade, let's call it. And then there was another sort of set of pie graphs that had US non-bank lending as a proportion of all lending against banks, and the smallest slice was banks. And then it sort of looked against the Australian landscape, which was the exact opposite. One of the other things that I suppose we would be talking about now, and so we will, is that the Australian non-bank lending, I guess, volume, it's about 188 billion. It's been rising year on year, 16% over the last couple of years. Against the US market, I think that's about 1.6 trillion in private lending. So what I'm, I guess, trying to demonstrate is the market will drive towards where the profits are. And so 20 or 30 years ago, we always say, back when banks were easy to deal with, and that was when it was unregulated. And if you had a lot of equity in a property and you could see a transaction that was going to work for you, you could go to the bank manager and nut out a deal. And then Dale hinted in the 50s where the finance in farming was in the elders and places like that. And I guess everything old's new again, because it was sort of non-bank lending to start with. It's gone into traditional banks where they're happy to hold balance sheet. And now that the bank market and bank industry where they get their money, it's requiring different returns and less risky returns. So there's a new, I guess, door that's opened up for private money. There's during the GFC, during again COVID, there was a lot of money printed to get us out of this. So there's a lot of cash in the system. Where does that cash go? If banks are returning probably only a little bit better than CPI, so if we look at a business that's making 6% profit, you take CPI off that, it's actually making 3% profit. And so that's how we look at finance and money. We'll move on from that one. There we go. If we look at the returns that the money is chasing, and money likes money, if I'm the person with the money, if I can find a return of 6%, 8%, either above or whatever, then that's where my money's going to go. Now that carries more risk because I don't have safety in numbers. So if I'm investing money in a bank, the bank goes wrong on one deal, I still get my money back. If I invest my money in a private funder, or if I lend directly and it goes wrong, well, then I may not get my money back, so I'm going to charge more for that. At the other end of it is the individual or the business going into this new wild west of lending and borrowing, often with their eyes closed and looking at the contract after they've signed it. So, and what I'm getting to, and people, I'm just going to say it, like sometimes it's sharky, and you really need to understand the education piece, and there's like a personal financial literacy piece that I think Australians lack because of the great support that banks have given us. You can't go wrong. Like, it's getting to the stage, if you do something dumb and it's fraud, then it's the bank's fault, which I just have a personal issue with. But then there's commercial financial literacy as well, which I think is a stepping stone towards us being an effective cohort of users of private money. And I guess that's probably where I'm coming from in terms of setting the scene. It's a real thing. I don't know whether it'll grow to the same extent as it does, or it has in the US and Europe for that matter, but it's absolutely a short-term fix to opportunities, and happy to talk about that later with any questions. Thank you, John.
The next one we're going to talk to is quite an I think it's quite an exciting new avenue where our RDCs are now looking at where opportunity is in their sector and finding ways to attract capital and therefore to be able to kickstart some of the innovation development. Jesse Reader is the Head of Investment Growth and Commercial with Hort Innovation. He is responsible for the external co-investment program called Frontiers, and we'll hear a bit more about that as Jesse goes through it. And specifically, it's a vehicle that's designed to accelerate big, bold initiatives in the horticulture sector, and it's actually one of the first of its type in the world. So, Jesse, I'll hand over to you, and what we're looking at here is how the venture capital sector is attracting capital into this ag sector.
Thanks, guys, and pleasure to be here this morning. Thank you for the opportunity. Anytime you get invited to a session in Canberra chaired by John Howard's a good day, so didn't want to miss that opportunity. You've heard a little bit there in the opening brief about what we're doing, but I think to just come back a little step and give you some context, with the RDC dedicated to the horticultural sector, we represent 37 levy-paying industries, and as part of our mission to distribute and expand R&D in the most impactful way we can, we've got multiple investment pathways and platforms to do that. And today I'm talking about our external co-investment platform, which is Frontiers, which is really interesting. It's we're in a really privileged position. We are able to utilise a small percentage of the gross value of production of horticulture annually to invest into incremental and transformational R&D. And we do that in several ways. And I should say, this hasn't come overnight. It's taken some really bold leadership. We've got a very active and engaged board and executive that have a high appetite for risk for transformational R&D on the assumption that's paired with really strong industry engagement. So I think we've got here because of that, and it's a really exciting time to be in horticulture. So when we look back some 18 months or so ago, we took a view to re-image this co-investment program. And when I continue to say co-investment, what this is a vehicle where we can invest up to 40 cents in the dollar alongside the market. And by the market, I mean growers, private organisations, corporate farms and so forth to empower cross-industry benefit and ultimately see, as I mentioned, greater impact above and beyond what we're doing on the levy side of the business. The re-imaging set about to ultimately simplify and expand the way that we can invest. The simplification came in several forms, and that was part of reducing the complexity around the themes with which we invested against. So they were very specific, the existing funds of investment, and by nature of their specificity, it meant there were times we were missing out on ultimately some opportunity. So we've broadened the nature of the themes, but reduced them back to 5. So we now invest against 5 themes, which are market growth, healthy living, adaptation and resilience, disruptive tech and capability building. And so they're more of a catch-all purposely to make sure we can allow all good ideas to have a seat at the table, but we have notional investment targets that sit against those to ensure that we're distributing those proportionately. This was all, as I mentioned, around accelerating and distributing this capital stack into R&D in a different way and getting that ultimately into the hands of growers in a quicker fashion. The new investment pathways, which I'll talk about on the next slide, were about us being more flexible with the way we did business and ultimately in doing that, hopefully attracting a more diverse audience as it relates to the stakeholders and service providers that we would engage with. So trying to meet the market a little bit more where our members and growers would like us to be. So what does it look like? As before I get on a little bit more specifically on the fund, we now have 4 investment pathways. We have our innovation partnerships, which are our mainstay. This has been the backbone, the BAU, if you will, of our Frontiers program, where we work alongside industry to invest in the big, bold ideas that multiple industries want to see take forward, where you couldn't do this ultimately just in your individual levy-paying sector. So we see things, anything from biosecurity through to large programs around protected cropping where multiple industries will receive benefit. That only real change that came into that through the re-imaging was an unapologetic, slightly more commercial view. So it really has to be about closer to getting to that fastest way to failure, bringing growers right back to the centre of those investments and ensuring that there was some real strong rigour and governance around the way that they would unfold across the years of investment. The 3 new pathways to the right, which I won't spend a lot of time on, are the new babies, the new shiny toys, and we're really excited about these. So Australian Grown Innovation is essentially a pre-accelerator program that will give rise to the on-farm idea, the itch you want to scratch, that it's all about backing Aussie ingenuity and saying that at the heart of farming, growers are entrepreneurial, and so let's give them the platform they need to give rise to new revenue creation, business models, and ultimately maybe ideas and technology for solutions into the future. I'm going to move past the middle fund there, the middle opportunity, incubate and accelerate right now. That's under construction, and that's about us ensuring that we build what the market needs. So not building something for the sake of it. So we're doing a fairly deep dive on what is required in that space. And for today's discussion, this is about the Hort Innovation Venture Funds. This is a really quite unique and really exciting opportunity for the sector. And we sought in part some inspiration from GRDC on the grain side, where they've led the way here around using this vehicle again to accelerate R&D and distribute some of that R&D expenditure in a different fashion into early stage high growth companies. We are just going live now on a fund which is the first of its kind, certainly in the Southern Hemisphere, and if you look globally, I would challenge you to find a Hort-specific venture fund where its mandate is very much on that fruit, nut and veg sector only. So we will invest, again, alongside co-investors to establish this fund with ultimately the mandate of delivering sustainable and long-term solutions to the Hort sector. And in this instance, our way of participating is to support them through early stage investment.
What we've actually touched on is a lot of new sectors around green financing opportunities, how non-bank lending and private credit is coming into play. Jesse just then with how our RDCs are evolving through and trying to attract in. Our next one, David Bryant, is Managing Director of Rural Funds Management. So RFM's been in place for nearly about 30 years now, approaching that. It's got 2.4 billion invested into agricultural assets, almonds, poultry, macadamias, cattle, cropping, viticulture, water across 5 states. So very established, and still evolving and growing. And what David's going to help us through is some of those into that sector is attracting private equity and co-investment into ag. So David, I'll hand over to you and we can go from there. Yep.
All right, just a quick background on rural funds management. So we manage 2.5 billion, there's 240 staff, 741,000 hectares. We're in a whole range of commodities and spread primarily on the eastern seaboard because it's closest to home. Our main business, and I'll just take you to our main business now, is a fund that we listed on the ASX about a decade ago, a bit more than a decade ago. It was a merger of several unlisted funds that we had. we had a lot of retail investors, and when I say retail investors, I'm referring to you and I, you know, a personal investor who's investing to accumulate assets for their own retirement or whatever purpose, but it's generally people seeking to save and accumulate funds for their retirement. And even if you look at the big foreign funds that are coming here to invest in it, primarily what they represent is mums and dads who need a pension or an income in their retirement. That is, you know, the retail investor or the personal investor is the ultimate recipient of the returns that we're seeking to generate. And they're the people who we are responsible to. We had 3 funds prior to 2014 or 2013 that post the GFC, they were not sufficiently liquid. The ability to enter a fund and exit a fund is a fundamental requirement of an investor, and the solution to that was to merge those 3 funds and list a fund on the ASX. One of the difficulties with having an agricultural business listed on the ASX is the volatility that you get between years because of the slings and arrows of commodity markets and seasonal conditions. And that volatility is quite unattractive to investors who can invest in a whole range of different opportunities to maximise their return on investment. So we're competing with those other opportunities, and we had to come up with a solution or a structure that would provide a reasonable risk-adjusted return for these investors so that they would be attracted to what we had to offer. The solution was to create a property trust. So basically, the Rural Funds Group, which has got an ASX code RFF, it is a fund that its primary business is to own agricultural assets or particularly farms and rent them out to other companies or individuals that want access to the product that they produce. Part of that product, of course, is the profits. I'll just go back on the right-hand side. You can see there just a whole lot of logos, and these are companies that are leasing assets from the Rural Funds Group. They're primarily large agribusinesses or institutional investors that, again, managing money for the ultimate recipient, which is people like you or I who hope one day to miss an ABARE conference and be at home retired. Of course, that depends on the investment returns that people like me generate. So you can see the returns we've generated there. There's 11.4% compound annual growth in the net asset value. We've also had dividends or distributions going out to investors every quarter. That's been growing at 3.3% per annum, and it's that growth in distributions that is actually a fundamental need of people who are retired, because they can see that there's inflation out there. They need the return on their investment to be providing them an increasing return each year. They're very demanding, these people, but it's quite reasonable. Just before I go on, I suppose what I'm harking on is the observation that investors require a reasonable return on their investment. And what I mean by that, in a more, to put it slightly more in a more complicated fashion, is a risk-adjusted return. But let's just call it a reasonable return on their investment. I observed many years ago that after studying a lot of the fine work done by ABARE, I was able to validate many years ago that agriculture was capable of producing a reasonable return on investment. And based on that simple observation that investors require a return, agriculture can produce a return, I based my career, and so far so good, although there's ups and downs. And in talking about ups and downs, that business, the Rural Funds Group, its shares are trading at about 50% of its net asset value at the present, because over the last couple of years we have been unable to grow the distributions that we are paying to investors. And investors in a liquid market can react very quickly and sell. And so we are in the process of turning the corner on that, but it's I suppose it's emblematic of the challenges of managing money for investors, because they have these reasonable demands, and the bit of the disconnect in agriculture is sometimes the volatility in agriculture will have years when it misses it and is unable to meet those, address those demands consistently. This is just a I suppose getting down into some of the nitty-gritty of what we do. Is we are brown shoe property developers, or Blundstone boot property developers in some ways, because what we do is we'll buy a farm, look for a farm that is sub-optimally developed, and we will bring in capital to that farm that we have purchased and improve its infrastructure, and therefore, with the objective of improving the return on capital that we've got on that investment, or that we can generate on that investment. There's 2 farms there. These were irrigated farms that we have, where we have increased substantially the amount of infrastructure on those farms, and so therefore more fully utilise the water entitlements on those farms, and therefore getting better, I suppose, capacity utilisation of the natural resources that come with those farms. And to make it even simpler, buying a farm that doesn't grow many crops and then convert that farm with further irrigation and grow lots of cotton. That's really what these 2 businesses are about. And that's maximising the return on our investment on those 2 farms in that part of Australia, and that's in central Queensland. And so what we've done with those farms is we've developed them, and then we have rented them out to a group called the Rohatton Group. That's a New York-based investment company. They are co-investing with a large institutional investor, foreign institutional investor, and so they are renting those farms from them, but we also sold them a 50% interest in those farms as well. We've had another transaction with that particular group where we've rented 100% of macadamia orchards to that investor. And those investors have entered into that transaction because they perceive that we can generate a return on their investment that meets their requirements. What that enables us to do is collect rent and deliver a return to our investors in the Rural Funds Group that satisfies their requirement. So it's really about getting the needs to meet each other, but it's not simple, because prices are volatile, seasons are volatile, and managing all of that is challenging. But that's that's been the work of 28 years, is developing the team of people that are capable of managing that and mobilising and reacting to seasonal challenges, but changes in market conditions and more structural challenges as well. So some of that, we can touch on that when we get to Q&A perhaps. I'm just mindful of the time. That's my 10 minutes, which is probably more than enough. So look forward to answering questions soon. Thank you.
Thanks very much, David. That's a great ground to actually launch on to some questions now. So please, there's roaming mics. Put up your hand, please, and we'll make sure that a mic actually gets to you. If you are introducing it, please introduce yourself when you do put up your hand. And then we've got some that have been coming through on the app and the mic as well. So really interesting context across a number of different areas. I've got a range of questions here myself, so I might actually kick things off. And Nicola, I'm actually going to come to you in the first instance. Is from your discussions with farmers and financiers, what are some of the drivers of green finance and those opportunities that's come out of the study that you've seen?
Thanks, John. So the drivers of green finance are really around sort of the younger age group farmers, and they're looking to improve their farm productivity and sustainability. And the real key drivers that we've found aren't necessarily coming from the finance sector at the moment. It's sort of government-funded incentives, subsidies, programs that they're sort of putting in place that have really, the farmers have then seen a way for their highly leveraged, capital that they can finance an improvement with their on-farm activities, improve their water use, reduce the amount of evapotranspiration from crops, whatever it might be, and that they can sort of do some of those capital upgrades that they couldn't really otherwise if they didn't have these. So I think that the government incentives have provided a really great space to really improve some of these on-farm infrastructure, and it's been those younger farmers that have really jumped in on board with them. But some of the barriers have been that they have found it really difficult. They're busy people, they've got young families, and there's a lot of paperwork to get through, and it can be really, really confusing. So there's also an opportunity for the finance sector to sort of jump in potentially, and that's an avenue where projects still ongoing. So happy to talk to any financiers about what they think to bring it into the project.
Well, it's probably a good lead into our non-bank private credit representative here. So, Charley, so an adjacency to that is what's actually led to the increase in private or non-bank lending in Australia?
Yeah. It's 100% market driven, and that's I've kind of answered the question there. What's led to it in a more, I guess, a detailed way has been the way that banks have become regulated a lot more strongly, throughout Australia. We act in a world where the money comes from all around the world, but Australian bank distribution is not restricted necessarily, but it's watched very closely. And then, the market, so the shareholders of banks are expecting a certain return for a certain amount of risk. And that's good, but the actual borrowing market sometimes needs to pay a little bit more for a better opportunity. And often private lending is a short-term transactional kind of piece. So the example was those two farms that were bought in Queensland. They were purchased with an exit that was sell half of the value of and I'd expect the new value of the farm to a purchaser. So they might have been bought for, 20 million, whatever it was, then done up, then sold for 40 million. That 20 million went back and we still leased it out. So in that transaction, potentially the original purchaser would have borrowed the 20 million to start with. Over a period of 2 or 3 years, they've redeveloped the farm and sold it and then got their money back. And that's a great example of how private money would work, because the transaction can happen quickly. The cost, the interest rate would look abhorrent on a page, but because it's only a 1 or 2 year transaction, it's a cost of doing business, and it's a business decision, not you're not buying it for 30 years and then the rate is important. It's a 2 year transaction. Those kind of, let's call them deals, are the kinds of things that in the market drives private lending. And again, it's the cash wanting a return above inflation. And so, if you've got $1 million, in 3 years' time you've got 900,000. That's the real value of how it works. So you've got to beat CPI to start really making money.
Yep. Thanks, Charley. We're starting to see some questions coming through online, and when they start with that they're saying fantastic session, I'll make sure that gets some visibility. David, to what extent are investors perceiving ag assets as natural capital investments?
I think, so I'll go back to the Rural Funds Group, our listed entity. There's 20,000 retail investors in that, and then there's probably, and they would own 65% of that fund. The other 35% would be probably 20 institutional investors who, again, having money funneled into their funds that, you know, that are coming from the people like you and me again. All of us don't think of it as natural capital. We think of it as an investment in agriculture. Some of the institutional investors are seeing it as an investment in property, and they're actually specialist property fund investors. So in the listed environment, it's not thought of as natural capital. If you go to the unlisted environment, which is unlisted institutional investment environment, and by that I might mean, say, the largest investor in Australian agriculture is PSP, a Canadian pension fund. Again, have a look beneath that. They're looking after people looking for a pension in their retirement. But PSP and all of these institutional funds, the Australian super funds, the North Americans, the Europeans, they have a system, I call it pigeonholes, but they call it asset allocation. But if you went 20 years ago and said, do you want to invest in agriculture to one of these, they would say, well, where do I put that in the portfolio? And where were they coming from is, which pigeonhole does that go into? About, I'd say 15 years ago, it was led by forestry actually. The market evolved and they created a new pigeonhole called real assets. And then it evolved a bit more, and that actually included infrastructure like tollways and things like that. Then they got the pigeonhole and divided that into two, and then had this thing called natural capital. And so natural capital really includes, the main ones are forestry and agriculture. So for all of those foreign investors, and they are by far the dominant institutional investor in Australian agriculture, to a lesser extent a bit of money from Australian super funds, but that seems to be in reverse at the moment. If you look at all of those, they are thinking of it as natural capital. Sorry for the long answer.
Covered a different, probably actually gave a good insight though into the different ways of defining how people actually do put a label against things and how investment comes through. Jesse, I've got one for you. Why Hort Innovation, and what value can be added?
Why not?
Or can you add?
Yeah,
Right.
I think, no, I don't say that to be cheeky, why not, but we've looked at it and said, why not? Like, why can't we participate here? And I spent a lot of time sitting around making sure I can defend that and answer that. And I keep coming back to, and I should preface this with the fact that there's lots of commentary at the moment and a lot of narrative around does VC suit ag tech investment. So those of you that are interested in this topic, go down a rabbit hole and you'll see some really interesting commentary at the moment. But most of it, I'll save you the reading, is around the suitability of that asset class to venture capital investment, and do the timelines suit, and is there enough patience, and do we understand the market well enough? And when I hear that, I'm actually buoyed by the fact that we're involved, because I think one of the, there's several things we bring, but these positive attributes are as much as anything around these deep data and insights we have for the sector. So our ability to support these early stage companies and inject them into the horticultural sector with the knowledge of how it operates is really, really powerful. I think the domain knowledge and mastery that exists within the business, or one phone call away, is incredibly powerful. And I've spent a lot of time with early stage ag tech businesses, and that's the part they're always looking at. How do we enter your sector? Who do we talk to? Where are the cornerstone growers? Which part of the market's moving? What do we have to be mindful of? What's the cost of production? And that type of inquiry is really, really critical to get the clear answers for when you're entering a market. And we're really well placed to do that. And when I say the contacts, we're incredibly mindful of not abusing what is a very large address book within horticulture, but that is something that we also have equally on the demand side. There's really high appetite from our members to be connected with these businesses. Everyone's looking for an edge. Everyone's looking for an opportunity to work with these businesses and just get one step higher on the ladder. So I think we should be really confident in the position we're taking and the reasons that we're doing it.
Yeah. No, it's an exciting one, that's for sure. One of the common themes and messages that's been coming through here is around the pricing of risk, and we went through the sessions yesterday with what's happening globally at the moment and that uncertainty and how it's coming through. And also as new products actually come into the market where there's probably hasn't got the history behind it to actually understand the inherent risk, is how does that actually get priced in? So that's a bit of a preface to a question that's coming your way, Nicola, in the green finance space, which is, again, relatively new to the market. How is this impacting market participation, and how is risk actually being priced in that?
Thank you, great question. So I think it's been touched on by the rest of the panel that investors want a return on their investment, and risk is a really big issue when there's some new sustainable product that's on there in the green finance space. Well, is it going to be actually sort of give them a return on their investment? Is this going to actually work? So from the supplier side, from all the finance side, that you want something that's going to give you a return on your investment. That's what we've been hearing. So it's really challenging that they want that premium price, because there's a lot of other investments out there, as we've sort of been hearing, that may be potentially less risky than agriculture. And we're only seeing today, I'm sure it continues to evolve in the global political sphere, that everything's getting a lot more risky. And we've got to put in place that climate risk on top of it. So agriculture can be quite a risky space. So the green finance, they're really wanting that extra percentage on top to sort of protect against the fact that they may be giving some farmers and investing in something that they don't know if it's going to actually generate the returns that they want. Or it could be like a particular farmer I talked to, he's like, yeah, I put in a whole bunch of netting to protect my citrus crops, to reduce, wind impacts and reduce water use. And then a year later, he'd spent, I can't remember, it was, 100 grand, 200 grand, it all blew away, and he had to do it again. And so that's up around Loxton region. So we've got all those climate risks in place, and that you may not, he's just like, well, it's gone. It's, what do you do there? So you may not get that return on investment. So it also becomes, from the farmer's side, that they've got those risks, and can they afford to pay that higher price for those green funds and that green finance, particularly when you see banks or other people may go, oh, we'll give you a 0.5% discount for this green finance. Is that going to work? So that's, some of the challenges around the green finance space.
So leading on to that pricing of risk, because one of the things there is what we're talking about also is how do we actually increase the rate of adoption of new techniques and everything like that, and therefore part of that is lowering the cost of capital. So Charley, in the private or non-banking lending sector, do you see it actually becoming cheaper?
Very good question. Yes. Over the longer term, so we go back to my pie chart that we saw for a second, the volume of dollars in overseas markets that's private lending just naturally says that it is going to have, market is going to say that there's more of it, it'll be cheaper. So as the Australian market grows, and I'm seeing it a little bit, so some of these pension funds are coming in where you can actually borrow non-bank money at pretty close to bank rates. There are some other restrictions, but you can do it. And that's because, again, of the volume of funds, of the pool of funds of where they're coming from. So in Australia, so if it's Australian generated private lending, at the moment it is a little bit more expensive, but I am seeing it coming down, and I'm seeing more market tension reducing the overall cost. And not because the people with the money want to take less money, it's that they're getting less opportunities to make a lot of money. There's more cash coming into the cycle. So I think, today we still need to look at the transaction. Does it make sense from a transactional level? Then yes, I'm happy to pay. In the future, yes, it'll make more sense potentially, but there could be other costs.
Couple of different questions here, David. I'm going to channel it to yourself in the first instance. So one of the ones that's come through online is a lot of the investment talked about today are tied to irrigation water in some of those development opportunities. What happens during a drought? Is this a case of the market picking winners? And the other question that I had here, which is probably something similar to this, is are different investors targeting different agricultural sectors?
Yeah, okay, so the emphasis on irrigation, why is that? Or was the question, the tail of that was, is it a case of picking winners?
Is this a case of the market picking winners?
I think I'll refer to it as investors rather than the market. Excuse me. So the large body of foreign institutional investment into this country is coming from North America. The history of those North American pools of capital was that this is a bit of a walk back in time, but life insurance companies in the United States used to lend to farmers, and then there was a big downturn at around about 1980, and it was a consequence of rock bottom commodity prices and then high increase in inputs and so on and forth. There was a lot of insolvencies amongst the farming sector there, and a lot of the life insurance companies, rather than repossessing those farms, chose to actually rent them out. And that's actually the genesis of institutional investment, equity investment in agriculture. And that was primarily in row cropping or in dry land farming or irrigated farming. And all of these Americans, whenever they come here, they say, we want nothing with legs. And they don't want to invest in livestock, so much so that I think some farmers will actually chase the livestock off the farm, and then the investor will come and then they'll put the livestock back on after there's been things like that occur, but I think they are adapting to the Australian the Australian environment where there is livestock on a portion of the farm, and there might be dry land cropping on a portion of the farm and irrigation on a portion of the farm. But that foreign institutional investment has been largely attracted to the growing of crops, whether it's dry land or irrigated. In the case of our business, we are not predominantly, the majority of our investments actually include irrigation. We think it's a way of moderating risk, and we utilise high security entitlements rather than general security entitlements, so they're more reliable, and that's a way of managing risk. So I suppose that's how we've come to it. Ironically though, rain-fed, pasture-based agriculture can have less risk in a lot of circumstances as well, and that's probably beyond the scope of this conversation. I wouldn't, talking about risk and the idea of agriculture being risky, I have a slide there. If you could bring up my presentation again, and if I could have the clicker, I'll just show you a comparison of land values. Thanks, John. A comparison of land values over time, because I would make the case that investment in the land itself, and that's the water entitlements and the rainfall that land receives, is actually a very moderate risk compared to many other property classes or asset classes. Thank you. There you go. So I'm just going to actually have to stand up so I can read the chart. So I'll just elbow you out of the way, John. Okay, so that's Australian. The top chart is Australian farmland values, and you can see how it's performed over that period of time. The bottom chart looks at the same thing again, and it's comparing it to other asset classes. And you can actually see, compared to the ASX, land values, in fact, is way less volatile than investing in a portfolio of shares. And so, the institutional investors in our fund are very attracted to that fact, and they appreciate that agricultural, that the actual underlying land itself is not that risky. And historically, it's gone up by about 5% per annum, and that's since 1890. So that's a pretty long data set. And so it's a great asset class to be in. It's the operations that are volatile. It's how you manage that. Now, there was a second question. I'll give a shorter answer to this one, sorry.
And that was, are different investors targeting different agricultural sectors?
Yeah, I'll probably explain that a little bit from the history of the US investors. The Canadian investors, it's interesting, people do bring their own mindset that they've grown up with in their country or where they've come from to what they invest in. It's interesting to see, for example, Victorian funds managers invest in dairy. Queensland funds managers in agriculture invest in beef. If there's a Western Australian one, it'll be wheat. In the case of the Canadians, they're quite happy with legs, and so they will invest in livestock. The Europeans, they actually will commonly have a more green focus, that was explained to a Danish man that I met years ago, and he said, well, we got acid rain first, and we experienced environmental degradation before anyone else on the planet, and that, I think, is the genesis of the European focus on greater emphasis on environment. So yes, definitely there are preferences.
Yeah, without a doubt. Jesse, this one's actually for you, and there's probably a couple here as well. Does your co-investment model provide further opportunities to de-risk the venture capital investments you will make? And then the other one I've got here is, will your fund only invest in Australian companies?
Beautiful. So broadly, our Frontiers co-investment model will absolutely help de-risk some of the investments into the fund. And the shortest way of explaining that is because we have now 4 pathways with which we can invest at different stages of maturity, dilutive, non-dilutive, etc. It means we could actually invest in that innovation partnerships channel that I showed, where we could actually include one of these early stage businesses in an industry project or program where we could get exposure to them, industry could see them, we could follow them through a 2 or 3 year program before we look to take equity into that business. So it's actually a really interesting way of de-risking and getting high exposure to the organisation prior to potentially taking equity. So yes, it does de-risk it. Part 2 of the question is, I haven't spoken as much about the fund, but so it's important to understand we'll invest between pre-seed through to Series A, so much earlier in the piece, so lower TRLs and commercial readiness levels, purposely because we want to be able to spread our view across as many racehorses as we can to see different core technology and get a real understanding of some of those breakout areas that we think might be on the horizon for our sector and in a more cost-effective way. I think where we can make the exception will be where we can make a clear argument for international investment is where there's application for learnings in the Australian market. So where there's not obvious candidates locally with skills and technology to meet market failure or need here, we'll look offshore, and we do have the ability to do that. So that's an additional function to the fund that will be really beneficial. Thank you.
Thanks, Jesse. Look, we've probably got time for one more question, and I'm probably going to direct this at you, Nicola. Is initial outlay and temporary decrease in production is a big barrier to adopting sustainability processes. What are the thoughts on capital sources such as supply chains and sustainability credentials?
So that is a big challenge, and I do know that the farmers we've talked to in terms of sustainability credentials, that's sort of one of their bugbears, if you will, that they're sort of getting it pushed down the supply chain, that as if they want to maintain, sort of entrance or maintain their spot in a market, that they're really struggling, that they need to undertake a whole bunch more stuff. And as we all know, farmers would prefer to be out in the tools instead of in front of a computer. So those additional reporting requirements they're really struggling with. And that also that I think that's one of the big barriers to the sort of, uptake of these new sustainable processes is that they're really struggling with that capital investment and that lag, particularly if you think the ones that are sort of the most interested in doing it are the younger ones that are highly leveraged, the farmers that are sort of, older, that have got a larger capital stock, and that they can actually take that hit of maybe, putting out an investment there. It might be a drought, they may not get their water allocation, but that's okay, they can weather the storm. They're sort of not so much interested in doing that and taking it. So it's really the younger ones don't have that capacity to really weather that sort of loss of income. by undertaking that sort of capital investment. And again, that's why they've got a real strong preference towards these sort of, subsidies or payments that the government's made for incentive programs. So I think the real challenge for us moving forward is sort of going, okay, well, how can we, from the finance industry, move away from government-funded incentives that are being used by farmers to, increase their sustainability, to working with, sort of different sort of funds providers to then provide them. And I think there's a whole space there in the development of the nature positive markets and other sort of sustainability avenues that potentially there's something there in the future, but we sort of wait and see with the political climate being a bit uncertain, and there's a federal government election coming up, so wait and see with that one.
Thank you very much, Nicola, and quite pertinent one to end on, because the exciting thing about the ag sector is we've seen today is that there's a hell of a lot of opportunity that's actually there. And what is also evident through the range of speakers that we've had, but also traditional means of capital, is there is actually provisions and there are avenues to actually go and enable the development and the capability increases, whether it's land use change or productivity improvements through technology or other forms. There are different ranges of being able to access capital to enable that. So massive thank you to everyone that put questions through. Sorry, we're running out of time, so I aren't able to actually get to all of them. But I'm suggesting that a range of the panellists will be about after here, so please come forward and ask questions after this one. But if I could ask you please to put your hands together, Dale, Nicola, Charley, Jesse and David, thank you very much for the time today.